All right, so we've spent considerable time examining the functions and services that financial intermediaries provide, like liquidity, risk mitigation, and overcoming information and transaction costs. Now let's shift our focus to categorize these different institutions. Financial intermediaries are generally divided into three main groups based on how they acquire and utilize their funds. So let's get started. So in this section, we're going to identify these categories, discussing the four main types of depository institutions. We'll then examine contractual savings institutions, which include pension funds and insurance companies. And then finally, we'll conclude by reviewing the various types of investment intermediaries like mutual funds, hedge funds, and finance companies. So the first major category of intermediaries is depository institutions, which are commonly thought of as just banks. All right, they're characterized by the fact that they obtain the majority of their funds from deposits made by the general public, including households and businesses. They earn income by lending those funds out at a higher rate than what they pay to their depositors in interest. The term depository institution encompasses four main types. First, we have commercial banks, which are typically for-profit, publicly traded companies that offer a wide variety of services, like consumer banking, real estate banking, business loans. The other three are often grouped together as thrift institutions. These include savings and loan associations, which historically focused on mortgages, as well as mutual savings banks, which are owned by their depositors and generally found in the northeastern United States, and then credit unions, which are nonprofit financial cooperatives owned by their members. Credit unions often return profits to their members through lower interest rate on loans and higher dividend rates on deposits, which helps distinguish them from the shareholder-driven commercial banks. The second major category is contractual savings institutions. These intermediaries acquire funds by accepting regular committed payments from individuals according to a predetermined contract. Because payments such as insurance premiums or regular pension contributions arrive on a highly predictable, steady schedule, these institutions have a reliable inflow of funds. Given that their financial obligations, like retirement payments or insurance payouts, those are often long-term and fairly predictable. So they primarily invest in the capital markets because they can purchase longer-term securities, get better rates when they purchase corporate bonds, stocks, and things like mortgages. There are three major subcategories of contractual savings institutions, and these include pension funds, which provide retirement income, life insurance companies, which invest premium money based on actuarial mortality rates. That's a mouthful. Actuarial mortality tables. So basically, they look to see like how long are you expected to live? When do they think you're actually going to die? When is your mortality going to end? And based on that, they make their decisions. And then the third category is the property and casualty insurance companies. They insure against damage to assets like cars and homes. So unlike commercial banks, liquidity is just less of a concern here for contractual savings institutions because their obligations are easily forecasted and usually they're all pulled together. The third and final broad category is investment intermediaries. So there's a lot to talk about with this one. An investment intermediary is a financial firm whose primary purpose is to raise funds so they can invest in securities or make loans. These firms act as a mediator for executing financial transactions between those who have capital and those who need it. This group includes mutual funds, hedge funds, and finance companies. So let's start with mutual funds. A mutual fund is a professionally managed investment fund that pools money gathered from many investors through the sale of shares in the mutual fund. The fund then uses this capital to purchase a diverse range of securities, which can include equities like stocks, fixed income instruments like bonds, and various short-term money market instruments like treasury bills or commercial paper. They are often structured around a specific investment objective. For instance, a fund might specialize in municipal bonds for their tax-exempt status, or it might focus on high dividend stocks. Because a single mutual fund can invest in hundreds or even thousands of individual securities, they offer diversification that helps offset the risk of any single investment performing poorly. This pooling mechanism is advantageous for individual investors because it significantly reduces the overall transaction costs of creating a diversified portfolio. Crucial to remember that while mutual funds facilitate broad investing, their shares are not guaranteed by any federal agency, meaning the investor carries the risk of the loss. So next there are hedge funds. So like mutual funds, hedge funds pull money from savers to make investments. However, they are structured very differently. Hedge funds are generally set up as financial partnerships limited to a small number of investors, typically 99 or fewer. These investors are usually wealthy individuals or large institutional investors like pension funds. And so, because they operate with a limited number of very sophisticated investors, hedge funds are largely unregulated. And this lack of regulation allows them to pursue much more aggressive and complex investment techniques, often employing high levels of leverage with the goal of maximizing investor returns, albeit by taking on substantially greater risk than a mutual fund. Again, if some of the terminology doesn't quite make sense to you yet, that's okay. A lot of the stuff is defined in the text, and a lot of the stuff is things we'll touch on again and again and again in this class. So when we talk about things like leverage, maybe that doesn't make a lot of sense right now, but we're going to keep hitting on these topics. And then finally, we have finance companies. A finance company is an entity that specializes in lending money to individuals and small businesses. They acquire the necessary funds for their lending operations by borrowing, often by issuing short-term commercial paper and bonds, as well as by issuing stock. The company's profits come from the fees that it charges during the loan processing stage and the interest rate charged on the loan principal. Individuals and smaller businesses will frequently seek capital from finance companies when they may not be able to meet the strict underwriting criteria required for a traditional bank loan. This means borrowers often pay a relatively higher interest rate compared to bank loans. Many large manufacturing and retail companies operate their own financial company subsidiaries. For example, Ally Financial is a finance company that's linked to General Motors, which lends money to people who buy a GM vehicle and choose to finance it. So that's going to close out this section. And the next, we'll talk a little bit more about investing in the stock market. And that'll be the last section of this chapter. I'll see you then.